Kenneth Andrade is now joining us to talk more about markets, how they are approaching, and of course, the new entity which they are floating. Kenneth, first of all, congratulations on the mutual fund foray. I'm sure a very large part of your followers and your admirers would be logging in along with a new breed of investors who are actually taking shape in India. We'll come to that in a moment. I want to understand your, one contra call which we've been speaking about since early morning today is metals. The way some of these metal counters are coming out with results, Tata Steel, for example, and you are in one of the minority side of the market which believe that actually metal converters or the Indian companies are a good bet, especially in an argument when they're saying US and Europe is weak, metals may not do well. You believe that they could be good bets. Is it the improved balance sheets you're betting on, or is it the India demand story? What exactly is the hypothesis there?
When you look at the entire commodity basket and specifically even in steel, balance sheets are not what they used to be, or the financials are not what they used to be in say 2015 to 2020. A lot of these businesses have been generating enormous amount of cash and also expanding capacity at the same time. So obviously it's a volume game, and we remain competitive across the world in terms of profitability per ton. Now, the only call that needs to happen, right, and this is through 24 and some part of 25, okay, is steel prices actually going to move up? And if steel prices actually move up, you can cash in on the next recovery of these prices. So valuations are as cheap as you can get them in a down cycle with a completely solvent balance sheet. So it's a matter of time and patience. We are not taking a call on the cycle because we do not know what really is, when will steel prices actually rebound. But 2024 calendar year, you will get a reasonably depressed environment as far as commodity pricing is going. But this should be the low point in companies' profitability. At this profitability, they are still reasonably valuable, or should I say very valuable.
Fair point. Right. Kenneth, the other very interesting name which I see in your recent editions is one name from the premium liquor segment, which is making a lot of waves. This part of the premium liquor or some of the other premium categories of the consumption basket have been doing phenomenally well, even when rest of the mass segments are doing bad. What is the hypothesis of adding premium liquor segment in your portfolio recent editions? Is it this company specific, or you like the category?
So it's company specific and the category itself, but the category is trading upwards. Look, India is amongst the top countries in the world with the per capita consumption of alcohol. So to tend to believe that we will consume more alcohol is not the right way to go. So once you've been able to get that base of users, you basically have to ride on the per capita consumption of per capita rise in income, which will create a premiumization trend that is there. So what's happening not just in the liquor market but the rest of the categories also is everywhere where there's a premiumization of the category, that category is done reasonably well. At the bottom end of the pyramid, in the bottom end of the consumption pyramid, you're seeing the reverse working around. I mean, the reverse in that sense is people are down trading. They're consuming the same amount of volume, but at a lower price point. And that's happening at the bottom end of the pyramid. So consumption in India is actually broken up into two extremes, right? In the premium top end of the consumers are premiumizing with volumes, and the bottom end of the entire population pyramid is consuming higher volumes but at a lower price point, which is creating a margin pressure for a lot of businesses at that end of the consumption spectrum.
Hi, Kenneth. Morning. Given that we were really banking on support coming in from the FII community, 30,000 crores though that we've seen in terms of a net sell figure over the last few trading sessions, is that unnerving, or is that sort of a precursor as to what could transpire for the rest of the year, or are we banking on FIIs coming right back?
So So India is doing well as a country, and there are a couple of other emerging markets that are also doing well as countries. But what out here for any investor, I think valuations where Indian companies trade is a very big pushback. Because there are some other larger businesses and opportunities that exist across the world, wherein the valuation trade is almost at 50% of where India trades at this point in time. So to tend to believe that we will get a continuous flow of this foreign capital when they have other choices, I think I'm on the camp where I'll be a little cautious about saying that FIIs, foreign portfolio investors, are going to continue to put money into a marketplace where valuations are trending high and there is very low margin of safety. So I'll be a little cautious this year to tend to believe that that will happen. And there are other markets around the world which are underperformed quite dramatically, which would get their fair share of capital also. So India is dependent a lot on their domestic capital flows right now, and we've shown in the last 3 years or 2 or 3 years that domestic cash flows or domestic investors are far larger than what foreign portfolio investors can be, and that structural change which has taken place is here to stay.
One thing which I find missing from your list of the holdings, at least what I am seeing, is the lack of large cap financial names. That's the private banking names I'm talking about. Have you been averse to that for any specific reason?
It's not a trade that we've participated in for a very long time. Actually, all of the last 5 or 6 years, we haven't participated with that trade. We've got a large lending name out there, but it's more of an NBFC. And to that extent, we tend to like the NBFC space a little more than the private banking space, so as to say. I mean, the opportunities as we see it is, and as the entire industry also sees it, is in unsecured lending, and that's a book which is growing significantly fast, and there is reasonable amount of demand. Plus, you get a higher yield also on lending out there, as long as you can control your risks. So that's where we're tending to navigate our portfolios, or tending to look at companies or businesses in that spectrum. So lending businesses are on the table, but as portfolio managers, we may not be. We'll stay out of the banking space at this point in time.
Okay, so that's interesting. So a two-part question. What will make your view change on the large cap financials? When you see value on the table, will you be looking at that? And secondly, you talked about unsecured lending being the growth driver. In that context, are you looking at adding some of those microfinance names which have been doing quite well of late?
I mean, nothing will change to make me. We're not looking for anything to change to recalibrate our thought process out here. And it's not that banking as an industry is doing badly, or lending as an industry is doing badly, because you have to go stock picking in that segment of the market right now. You have a bank which is doing very well and is hitting 52-week highs, and you have another large bank which is hitting 52-week lows. So it's basically a company problem, and it's a company problem if you would say that. And it's not really an industry problem. So category profitability is growing. You just got to move towards a place where the profitability is growing at a significantly faster pace than the broader GDP. And I think that's where we are moving towards. So to that extent, I mean, any business that we come across, like I said, we've got one large financial NBFC which is there. But we have opened up the entire category to see what really fits our investing profile.
Okay, Kenneth, wanted to understand how investors can really unleash the opportunities within the entire power space as a whole. There have been a lot by way of renewable energy stocks that have been in the spotlight, the schemes that have been announced by the Prime Minister, a sector as well that you look at. Can you give us your take?
That's a difficult one. So you will have to go with the, I mean, if you want to invest, and this is not really in our domain right now, because virtually every business out there is coming at a price point, and on a promise of the future, at a price point and the promise of the future. So if you have to put a portfolio together, you have to play in the direction of the news flow or the projected news flow, and figure out companies and categories that will participate in that in that part of the growth of the economy. So power as an industry is going to be very large. It's always been significant. Energy cost as a percentage to total sales would be anywhere between 11% to 15% of individual companies cost lines. Okay, so it's a large industry, but now you have to play in the direction of that entire industry. But one thing is very sure, that power costs are going to be inflationary. Inflation is very good for company profitability. Profitability is very good for cash flow. Cash flow is very good for incremental capex. So you're in a virtuous cycle, and because you're in a virtuous cycle, these companies are priced at where they are at this point in time. I mean, obviously there is a space or two in the energy space which is reasonably priced. A lot of it is trading like it is a sunset business, and I'm just highlighting it. I mean, a lot of it is in the oil and gas space, and that's probably the only opportunity that is around there. But you've got to tread a little carefully, because valuations of those industries depend upon what you would assign a terminal value to those businesses. Okay, and if it's really a sunset industry, then you won't get a real price earning re-rating like you've seen with the rest of the power companies or the contractors that address the power companies out there.
Kenneth, I see that you've added a lot more pharma names as well, whether it's Glenmark Life, Markson's Pharma, even Syngene or Aurobindo for that matter. What's the thesis when it comes to the pharma names?
I mean, a lot of it is already playing out. Like, step back to the last quarter numbers or even in 2023 numbers. You've hit the trough as far as the profitability is concerned, and now it's all incremental amount of growth that is there, and all of this growth is coming at incremental market shares that are happening across the world. So all these names that you did mention, and probably a lot more of them that are there, are addressing international markets of the rest of the world, including the US. And I think that's where the profit and that's where the pricing will emerge for a lot of these companies. So that's been with us for a while. We think, I mean, balance sheets are completely clean. Cash flow generation at its all-time high. And for all the companies that are there, that are addressing the West, volumes have started picking up. Now we got to see how margins come through, and margins will come through because, and margins also are not too much of a problem because you're starting on an extremely low base, which was in 2022. So margins will also come through. How large can these guys get? I think what you're seeing with numbers coming through is all companies are reporting a very good growth in volumes. We've got a margin pressure out there, but that's just the pricing environment that is there. All incremental capacities that these companies have also set up, and they've been setting up all capacities. They've been through a capex cycle over the last 3-4 years. They're yet to get utilized. So 2024 calendar year, a lot of Indian businesses in pharmaceuticals have their largest capex cycles going on stream. And incrementally from 2024 onwards, you will see volume growths. We haven't been able to get a handle on how profitability will grow, but that will also have a similar growth compared to how the top line or the turnover actually grows with these companies. So we are fairly constructive. It's also our largest holding in portfolios right now, and they don't trade at very abnormal valuations. They are higher from their baseline, but they don't trade at very abnormal valuations.
In fact, I have a follow-up on that one, Kenneth. I was watching, I mean, not going into the name which you have actually added, but I want to understand one of them, has a very big valuation re-rating opportunity, which we saw because the debt reduction happened. The only one of the few companies in pharma which had big debt, that started coming down. Plus, other part of the business there was value unlocking. The other one is actually seeing very sharp outperformance on the EBITDA generation. If the previous quarter number was anything to go by, do you see these two play out from here also? Yes, they have kind of moved up, higher EBITDA and of course valuation expansion as well.
Mm. Um, So yes, I mean, for the companies and the stocks to do well, now the denominator has to start moving, which is basically EBITDA earnings. And for those two to do well, you should have had capacities on the ground, and you should have gone through a capex cycle. I think the latter has happened. The former now has to play catch up in terms of the profitability has to. The capex is already on the ground, and the former, which is a um, profitability growth, should start happening. And it's not going to be a company or two, it's got to be an industry that grows profitability. Then if the industry's profitability pool is expanding, and we think it's going to be quite sizable in the next 5 years, the Indian companies or all Indian companies, all companies domiciled in India, which also have a few operating companies across the West, they will play into this profit pool expansion that is sitting out there. So I think that's what the opportunity, and that's where why it's also one of our largest exposures in our portfolios.
Before we let you go, Kenneth, congratulations for the foray into mutual fund space. Talk to us about what's the plan, because I see many of your peers also doing the same, and suddenly this space is hotting up. I'm told that there's big dearth of quality talent. I'm sure competitive landscape would also be slightly, stronger. What are your plans there?
Well, we've been in the asset management business for the last 7 years with a license. This was on the portfolio management space, and we did a few alternative investment funds also. This is just an extension of our product profile into the mutual fund category. Now, with the mutual funds, I think we can address investors from 100 rupees investment all the way to the HNIs, where we do have portfolios, or we do have family offices who contribute, who are investors with us, or who are investors in our funds. So I think that's the only extension that is there. Yes, you mentioned it right. It's a very competitive landscape, and across the world, it's a very competitive landscape. It's also it is also getting reasonably fragmented. So you have to find a niche. You have to build an investment style, investment team, and concentrate on what you do best. So for someone like us, which is or someone like us who've always been investment led, you would not see us build out a very large distribution base. We will lead with an investment style and investment portfolio, take it across the marketplace, and once the thought process is built through, then I think organically, like we've seen in our other asset management vehicles that are there, the investors would hopefully align with someone like Old Bridge.
Okay, good to have you on board. Interesting conversation there with your view on the markets.